Good afternoon, everyone. In today's video, I'd like to break down the volatility that we saw in the markets today. Specifically, we'll be taking a look at the S&P, the Dow, the Russell, the 30-year bond, gold, and silver. So those are the markets that you can expect to see as part of this video. But I've divided this overall video up into really four greater or broader parts. In the first part, we're going to start off by taking a look at the morning volatility note. This is something we send out to all of our Futures Volatility Box members, and the whole purpose here is to use this as really your guiding compass, if you will, for how to navigate the day in terms of volatility trading. What are any of the clues that we're seeing? Where should we be focusing on in terms of where do we have opportunity, predictable volatility? Which markets should we be ignoring altogether where we're seeing unpredictable volatility? Then after we take a look at the morning note, we'll then discuss which markets actually triggered a fade setup. We have two different setups. I won't break down the second setup, but a high level is a fade and a trending setup. In this video, we're going to focus in on the fades. So that's where we're looking at reversal opportunities. I'll make sure to link a video as well in the description box, which breaks down the trending setup as well for those that are interested. Then after we've discussed which markets have triggered, we'll do a quick high-level summary of the fade setup rules prior to jumping into charts, where we'll really break down each of these specific markets. So it's going to be a bit of a longer video. Feel free to use the timestamps if you'd like to jump around. For all of our Volatility Box members, you may be well familiar with 1, 2, and 3, so you may want to jump directly to the step-by-step walkthrough for the S&P, Dow, Russell, 30-year gold, and silver. The timestamp should help you navigate to the right market or the right portion of this video that you're interested in. All right, so let's get started with the morning volatility note first. And I've also linked a video in our description box, which breaks down the process of how do we come to these models, this data in the first place, that walks through, well, how do we send what we send out in terms of the models that we're choosing. And that video should give you an idea as to the how behind this list that's generated. In this video, we're going to focus on the what. So that's with this information, so what? And to try and explain that, I think it's important to first explain this terminology and what the different models are. And for that, we can come down here in the reminder section where you'll see the order that we've listed out for each of these models. Now, a good way to think about this is almost like a line chart here, where as we continue to scale up, so from the scalper, we go to the aggressive, the doomsday aggressive, and then the conservative, and finally the doomsday conservative. As we're scaling up, the volatility is increasing, and we should start to become more and more cautious. Now, to give you an idea of the doomsday conservative scenarios that most frequently occur, think of this as March 2020 time periods. That's when we're seeing a good amount of volatility in the marketplace. In several markets, we're most likely just sitting out, and the doomsday conservative models help us figure out where should we be focusing in the first place. Now, in today's case, if we break this down, the S&P and the Dow we're seeing we're both on the scalper model. So on this line chart here, the S&P and the Dow were really towards the far end in terms of the risk that we had. The NASDAQ, on the other hand, was on its conservative model, so that's all the way down here, almost towards our most riskiest end in terms of the volatility that we're seeing. In addition to that, we also had an open test on the NASDAQ. This is again discussed more in that determined volatility video that I'll link in the description box as well. But the whole idea here is we had an open test, and this test in itself ended up failing, and we ended up switching to our doomsday conservative models. So that was the updated model in the NASDAQ as the day progressed. In the Russell here, we had the aggressive volatility box as of 7:30, and that's to say one level higher than the S&P and the Dow. So we had the S&P here, we had the Dow here, we had the Russell here, and then on the far right-hand side here, we had the NASDAQ in terms of the actual indices. Now with our bond, the 30-year bond, we had the 30-year also on its aggressive volatility box. And so this is really the landscape for the indices along with the bond headed into 7:30 a.m. Pacific. Now using this information, knowing that the Russell along with the NASDAQ are both further along the volatility regimes compared to the S&P and the Dow, that's where we come to this idea that we expect volatility in the S&P and the Dow to increase and really start to catch up to the Russell along with the NASDAQ. And so that's how I would read what the landscape looked like for the indices along with the 30-year bond. Now, if we draw this out one more time for our energies and our metals, so let me draw that line along with where we had each of these models ranking. Crude and natural gas were both on their aggressive volatility box models. Copper had already broken outside of its doomsday conservative models, and we knew to ignore copper. It was not a market we cared to trade, not a market we were paying attention to. We could really just rule out copper right off the bat. But in terms of the volatility regime we were seeing, crude and natural gas towards the far left-hand side. Copper, on the other hand, broke far beyond the right-hand side. If we take the same thing now one more time with our gold and silver futures markets, so with gold, we are currently on the scalper volatility box model, and then with silver, we were on the aggressive model. So silver today, between the two markets, was the one that was displaying more volatility versus gold, in which we still had scalping opportunities. So that was the way to really read the gold versus silver conversation headed into 7:30. Now, using all of that information, we really knew that, hey, S&P and the Dow are the places where we have scalping opportunities. These are where we could reduce our risk for quick in and out sort of trade ideas. The NASDAQ, we were on our doomsday conservative models. We knew the risk here would be the greatest. On the Russell, we were on our aggressive models. Fairly decent risk, a little bit greater than the S&P and the Dow, but less than the NASDAQ futures. And then with the 30-year bond, we were on our aggressive models, observing this on the scalper. Now, one quick note before I move forward, the scalper models are still fairly new. They're currently available for the S&P, the Dow, the NASDAQ, the Russell, gold, and silver, and they're currently in beta mode or study mode in the 30-year bond along with the crude oil markets. For the remainder two markets, so that's natural gas and copper, the aggressive volatility box is the most aggressive model that we have available. All right, so hopefully this gives you an idea of the entire volatility landscape. We did that quick summary. You can replay that one more time if you'd like to break it down in a bit slower fashion, but that should give you an idea of what you can expect every single day right around 7:30 a.m. in terms of the morning volatility note and how you can use that note to try and prepare yourself for the remainder of the day. Now that we know the landscape, let's talk about what actually ended up happening in terms of real results from our fade opportunities for today. Now, in terms of the markets that we ended up having trigger opportunities that met our rules and triggered us into a trade, we had the S&P trigger us into two different trades. The first one was a winner, the second one was a loser, and the net result for the S&P for the day was positive 2.25 points, so fairly negligible. We'll discuss all of these trades in greater detail in part 4 of this video where we go through chart by chart, but in this video, I'd just like to really go through the numbers here while we still have the mapping available. Now, in the Dow, we had very similar two trades as well. The first one, again, a winner. The second one, again, a loser. However, in the Dow, the net differential here was negative, where we ended the day negative 11 points down in the Dow, or negative $55. So again, a negligible loss. The S&P, we were up $112.50. In the Dow, that was a loss of negative 55 bucks. Now, keep moving forward. The NASDAQ, off of its doomsday conservative models, did not trigger us into any trades, so no trades in the NASDAQ. The Russell, we had one trade opportunity. This trade was a loser. That was negative 11 points in the Russell. So that was a loss of negative 550. So far down in terms of the indices that we had for the day. Really just a quick sneak peek. Gold and silver is where we had the most success today in terms of trading. We also had one trade in the 30-year bond, and that trade too was a loser. Now, however, if we switch over to gold and silver, so if you remember, gold was the more aggressive opportunity in this scale, the one still on its scalper model. Gold gave us two different trade opportunities. Both were winners, and gold was really the star of the day for us in terms of P&L perspective. Gold was a positive 630 across both of those trades. Silver gave us one trade opportunity off of the aggressive models. That one trade was a winner, 92 silver ticks, or a gain of 460 bucks. Again, a nice winner, and really both gold and silver were the reason we were able to end the day positive today. But in terms of problem children, we had the Russell along with the 30-year bond, which were the two markets in which we had only one opportunity, and both places were losers. So that was not necessarily the greatest, but we'll go through all of these opportunities so we have an idea of what to expect into the future. Now, before we dive into charts, let's first talk about what the setup entails, and it's quite simple. For volatility box fades, we'd like to see price action breach our sign entry line. So that's where price action goes into one side or the other in terms of our extreme zones for volatility. Once that happens, we'd like to see an edge signal confirmation. That's either these red arrows for a short setup or a green arrow down here for a long setup on at least a 1-minute time frame chart. Once both of those rules are met and we've made sure that we aren't at places like, say, the edge of an hour, the trade is a go, and we're now looking for an opportunity to enter at the sign line or better in terms of our entry price. Now our risk on this trade is from our entry price all the way to the outside of the clouds. We like to give it a little bit of buffer room here, usually right around $50 extra for the full size contract. And then we're targeting the same amount on the opposite side in terms of our first target. Our second target is at the gray target line of the opposite side. So in this case for our short, our second target would be at the gray target line right over here. And that stop on that second contract moves from outside of the clouds to break even, giving us really a risk-free opportunity to try and see how high or how low is low. So that's the setup in a gist. So to summarize here, our rules are quite simple. We'd like to see a breach of the volatility box lines one way or the other. And once that happens, we'd like to see an overbought or oversold confirmation signal, letting us know that, hey, we now have an edge on our side and we can go ahead and participate in this trade. The entry and exit prices are also clearly listed right up here inside of the labels. All right, now that we've covered the setup rules, let's quickly go through all of the trades that we had, which should now be much simpler. So starting off here on the S&P, we'll use the models that we started off with. So the scalper on the S&P, you can verify we have the right model right here, scalper volatility box model. We had our first entry, the first winner in the S&P, when price action fell inside of our volatility box clouds. So that was part one, we breached the cyan line. In part two, we had the green arrow letting us know that, hey, we're officially in oversold territory. We also had an opportunity to enter at the cyan line or better, and that was where the trade got filled. Our first target was what we had risked, which was our distance from the cyan line to the outer edge of the clouds. That was 3 points on the S&P 500 futures, so fairly small in terms of that first target. Once that first target was hit, which was in this move up, that second contract stop was moved to break even, and our second target, as we mentioned, was the gray target line, which is what we ended up going to hit. So this was about a picture perfect trade in the S&P. We had T1, T2, fairly low risk. We didn't really have to deal with much heat on this trade. Everything just worked the way it expected. And that was the first trade in the S&P. Now, if we keep coming forward, you'll notice we had another breach towards the edge of that 8 to 9 a.m. Pacific hour. This was towards the edge of the hour, did not meet our trade plan rules, but it does mean we have free information where we can sit back and observe to take a look to see, well, what does price action do from here? Do we see buyers coming in and breaking price action above our previous clouds? Or do we instead see sellers coming in with some sort of strength here, bringing price action down to what would be our bare minimum first target? This is really free information. If I fast forward here, we luckily do have the answer now, looking back, where we had sellers come in. So far, the scalper model is still being respected. Again, breach towards the edge of an hour one more time. Free information, repeat the same exercise. And this time, if we come forward, what you'll notice is that free information kept us out of one losing trade. This is where price action here continued to go outside of our volatility box clouds prior to us hitting what would be our first target. And once that happened, that was our time to adapt to our volatility box models. So that's where we now switch over to our aggressive volatility box models. And the next trade came when we had price action breached. This was in that 11 to 12 p.m. Pacific hour when really the broader market started to fall. This is also after President Biden started to speak, where we saw a good deal of volatility in the markets. We had price action breach our cyan entry line. We had our oversold signal in this case, and instead we saw price action just continue to fall outside of our clouds instead of bouncing from this point. And this is the second trade in the S&P, the loss. Now, the S&P we spent a good deal of time just walking through. Let's now move forward here, where the next markets here should give you a better idea where we can keep things a bit faster. One quick note, after we had price action breach outside of the clouds here, we had to keep adapting to models. We switch over to our doomsday aggressive. We went outside of those clouds as well, which finally took us to not only our conservative volatility box clouds, but then eventually our doomsday clouds as well, where you'll notice price action continued to keep plummeting. Now, one quick thing to call out here for those that haven't seen the previous video, on the broader daily time frame chart, we are hovering near that 1618, which is what we're thinking will act as a magnet. All right, let's now move on to the Dow futures, and this time we're going to go through this much quicker, and I'll keep things on a zoomed out scale here. In the Dow, starting off with our scalper volatility box model, our first trade opportunity came when we had price action breach the upper edge of our volatility box clouds. We had now price action telling us that, hey, we're officially in overbought territory, looking for price to reverse. We had the edge signal confirmation. You can see the red arrow behind this chart bubble. We had an opportunity to enter at the cyan entry line. And then from that point, you'll notice price action really ended up reversing. If I zoom out here, you'll have an idea of really how picture perfect that reversal point was for the day, where from that point, the Dow never really saw the same highs again of 35,000. So that's one way where the volatility box models here can start to become really useful, especially if you have some sort of bias and you're using things like, say, DIA options. You can start to play this move a bit longer. And if you ride this with the futures, full-size futures contract, well, to give you an idea of what the total point here was in terms of high to low, that was right around 383 points from where price action had breached our volatility box zone, signaling us that, hey, we were looking for a short opportunity. So that's the Dow first trade, positive 26 points. Second target was at the gray target line. Both targets were again hit. That was pretty much the end of the trade there with the scalper for us, and we're back to looking for new opportunities. Now, one quick thing to call out, which we're really overlooking right now since we're focusing on the fades, but it's the amount of total bearish signals that we're seeing on our chart here. The Dow side, the S&P side as well. You'll see our slingshot squeeze all across, along with a bearish market pulse. All of this suggests that, hey, we have a trending setup now triggering, and we can play moves into our volatility box zone. Now back to the Dow. The first trade we already talked about. The second trade opportunity came again in that 11 to 12 a.m. Pacific hour. We had price action breach outside of our scalper. That then took us to our aggressive volatility box models, which then did a better job, at least what we thought at the time, of containing volatility. We breached our entry line. We had the edge signal. We had an opportunity to enter at the sign line or better. But instead here, the Dow was a bit weaker, continued to keep selling off, and we hit our stop there as opposed to our target on that second trade for a loss of 45 points per contract. So that was the S&P and the Dow, first and second trades. Now, if we switch on to the Russell here, let's zoom in. The trade opportunity came again in that 11 to 12 a.m. zone. First, starting off with our aggressive model here, we had price action breach our sign entry line. And from that point, we saw a nice reversal. This was that first target, and that came prior to us having an edge signal. So really, we just missed the trade opportunity here. We're now waiting. Retests aren't valid. And we see price action here starts to go outside of the clouds. That forces us to go from our aggressive to our doomsday aggressive. We're again adapting to volatility. And from that doomsday aggressive, we ended up breaching our sign entry line, having the edge signal. And this is really a much more aggressive trade, I'll admit, but this is where we were looking for a reversal from this point, which never ended up coming. Instead, price action here ended up going outside of the clouds as well. And the doomsday aggressive was really more of a product of FOMO, fear of missing out from that first trade opportunity, which hit its target. The second one here instead did not. We saw price action go outside of its clouds. And so that was a loss of 5.5 points per contract. That was a trade in the Russell. Keep moving forward here. We're on the 30-year bond now. If we zoom out, 30-year bond, very similar to the Russell here, just at a different time frame. We're in that 9 to 10 a.m. Pacific hour. We had price action breach our aggressive clouds. We broke outside of it and adjusted to our volatility. So went from our aggressive to our doomsday aggressive models. And off of our doomsday aggressive models, very similar here, thought we had an opportunity, a nice place to buy the dip. Price action breached our sign entry line. We had the oversold signals in this case. Thought this line really would hold in the sand. Stop was outside of the clouds. And instead here, you'll see the bonds were a bit weaker here, continue to go outside of the clouds, drift down lower, and hit the stop instead of seeing the buyers come in here and hit our target. So the bonds there, also a loser. Now let's switch over to gold and silver, which were the two winners, or winning markets rather, for the day. Gold, we started off with our scalper models. First trade opportunity, we already discussed this when talking about the setup rules, but it came when price action breached the upper edge of our volatility box. We had plenty of edge signals here and saw a really nice reversal, hitting T1 and T2 at the gray target line. That was the first trade. The next opportunity came when price action here, we went outside of the clouds, continued to adapt to volatility here, switched over to the aggressive model. We saw price action bounce into our aggressive volatility box model, again had the edge signal confirmation, and again saw a really nice bounce from our entry point with an opportunity to enter at the sign line or better. We had price action hit our target, and then our second contract here was taken off at break even when price action started to reverse back down lower. So just a plus 1.4 on that second trade, and then a plus 0 on the second contract in terms of points. Now, if we switch over to silver, which is the last market that we're going to be taking a look at, silver was a bit different, where we had the aggressive volatility box to begin with. We had a breach here of silver where price action hit our aggressive box. We saw a bounce away from it, but we never had an opportunity to enter. The only breach worthy that came, which met our rules, was between the 11 to 12 p.m. Pacific hour, when we had price action breach our sign entry line. That's step 1. We then saw the edge signal confirmation, that's step 2, and we had an opportunity to enter at a price better than the cyan entry line, which is step 3. And once all 3 of those pieces were met, we had the trade live in silver. Again, stop outside of the volatility box zone, where if we zoom out here, you can see just how nice of a reversal that was. When price action fell, we had really about the best opportunity to buy the lows of the day in silver and play this really nice reversal to the first target. The second target was not hit. We fell just a bit short of that, and we ended the day up just right around 25 ticks or so compared to our first target, which was 67 ticks. So a bit less on that second contract. So still positive and better than nothing. All right, so I hope this very detailed walkthrough of our futures volatility box, we covered the S&P, the Dow, the Russell, the 30-year bond, gold, and silver, gives you an idea of how to trade the fade setups every single day, how to use the morning volatility box note to try and understand what clues you can decipher here, where you should start to pay more attention to. You can also let that same information seep down lower into your stock trading, ETF trading, whatever else it is that you may be looking at. It really all starts with these broader markets and then filters down lower from there. All right, hope this walkthrough was helpful for all of our Futures Volatility Box members. If you have any questions, feel free to email us at contact@tosindicators.com. Otherwise, take care, everyone. Good luck trading, and we'll see you in the next update.